Our approach to absolute return fixed income really is about preserving, or at least restoring, the defensive characteristics of the fixed income asset class. Fixed income in Australia and globally has changed significantly over the last 10 years, but even longer than that, over the last couple of decades. What we've seen with respect to the high level risk return characteristics of our industry is a shift towards higher risk and lower return. That comes about through two different dynamics. Firstly, with respect to risk, the primary measure of risk in fixed income is what we call duration or interest rate sensitivity, or changes to interest rate sensitivity. That has progressively increased to now record levels in Australia. Conversely, yield, the return that's on offer, has progressively decreased as the world has dealt with some of the challenges that have been presented certainly in the last 10 years. So that divergence has created what we believe to be a fairly unstable environment for traditional fixed income product. So what we do is we aim to restore the defensive characteristics of the fixed income asset class. We begin with cash and we seek to add an incremental return of 2 to 3% above the cash benchmark before fees over the medium term. Key sources of alpha are multidimensional. Firstly, quality is absolutely paramount. So we build a high quality portfolio. Liquidity is important to allow investors to move in and out of our asset class so that they can take advantage of valuations in the broader diversified portfolio. But coming back to within our portfolio, the high quality portfolio will consist of allocations sometimes to government bonds when yields are compelling, and then we look to diversify into other sectors of the economy, and security selection is critical. Our research analysts drive the fundamental analysis to determine which securities we want to lend money to. Overlaying all of this is our macroeconomic analysis and evaluation of the Australian and global environment. The macroeconomic piece is really very important for constructing a high quality portfolio because it will help determine what level of sensitivity you should have to other risk factors. And so the sources of return come from our risk factors: duration or interest rate management, across market relative value ideas, currency valuations, as well as that credit allocation into the portfolio at appropriate times. We seek to sort of provide and manage the volatility for investors through a few different components. One is we begin with a high quality portfolio, so very high quality in terms of rating and soundness of credit, the ability to get your money back at the scheduled time. We take diversified positions across the fixed income market to add some incremental return, and we effectively also manage the downside through some tail risk hedge management. And these components all add to manage the volatility for our investors. Given rates are at record lows or close to record lows, we feel it's really very important for investors to move away from traditional fixed income allocations in their portfolios. It is important that they try to restore the defensive characteristics of fixed income. Cash, at the end of the day, is the ultimate defensive asset class in terms of volatility. Cash on its own, however, provides a very low return, like the broad fixed income market. So what you really need is an active manager to seek a return above cash by taking a diversified level of risk across different factors in the market to deliver that incremental return for investors over the medium to long term. One of the other changes in fixed income market in Australia in the last decade especially has been the growing interest of foreign companies, foreign entities issuing bonds in the Australian dollar bond market. This is important because you actually need to look at the Australian market through a global lens. Over 50% of the Australian market consists of offshore borrowers in the corporate bond market. So to understand the companies that you're analysing or that you're looking to invest in, you need to do the deep rigor analysis on that company. And so with a group like Franklin Templeton, we have that global perspective coming into the portfolio. In terms of those risk-return dynamics, Australia is not unique. Australia, like many countries around the world, has moved to those fairly unbalanced characteristics in fixed income. And so again, influences on Australia will come from offshore that sometimes will drag our yields higher and prices lower just because of something that's happened in another part of the world. We saw some of this in the August to December period of last year. Certainly before the election, the market started to move, but with the Trump victory in the US election, we saw yields spike significantly higher, and that dragged Australian yields higher. The impact on that on the Australian bond market is that prices declined, pretty much with no sort of domestic change in fundamentals. So viewing the Australian bond market through a global lens is really critical in our analysis to delivering return for our investors in Australia. Implicit in all of this is some active management in areas such as currency and duration, as well as some inflation or protection for inflation in the portfolio. So we think there are opportunities in different areas of the fixed income market, and we look to sort of rotate the portfolio between those areas as markets transpire.